This is Paul from Black Edge. I just want to review a trade that we took today out of the Discord. First off, hit that like button and subscribe to our channel for future trading and investing updates and information. We're just getting started, but we have valuable information of over a decade of experience as a professional trader and a professional portfolio manager. Um, we also have courses available on Teachable. I'll try to plug the link in here somewhere. And we also have a online Discord under Discord called Black Edge, where we trade in every day and we post a pre-market game plan and post what we're trading. We get on live voice chat and talk with other traders and talk them through our trades, what we're seeing, why we're trading, what we're using in trading. Is very helpful. We don't leave you in the dark. We walk you through it step by step and make trading fun. All right, so the three things that we use today to place this trade, we use the ES, which is the S&P 500 futures. We use the XPX, which is the S&P 500 index, and we use an XPX put option contract to place this trade. So, how did we find this trade? What made us take it? So we identified where institutional sellers were and buyers based off of supply and demand levels. We also understood that this trade happened yesterday, just over a longer period of time. We sold off from the supply zone down into buyers where the futures reversed and it began to push back up all the way back to this zone. So this morning, everybody was all happy because the market was opening green, but I understood that there's institutional sellers up there in that area, and we were opening right into a supply zone. So I planned in the pre-market, I said we open in the supply zone and we have high volume and we show signs of selling by candlestick structures. I want to take a trade to reach the area where we had buyers yesterday and where we had demand. So how did we take this trade? What did we see to enter this trade? And we'll walk you through that. So in pre-market, 2 minutes before the market opened, I saw we had entered this supply zone and we formed a basing candle followed by a bearish engulfing. We formed another basing candle followed by a bearish engulfing. We had high volume coming in right at the open and price couldn't push any higher. That's a good sign. We had all bullish volume coming in right here on this green candle where it was just nothing but buyers. They couldn't push price any higher because we had a very large seller sitting up here on the market, on the limit orders, selling, absorbing all those retail traders who supplied liquidity to the market all the time because they go off of what they see and not what they know. They saw everything was green, the market should go up, but being an institutional trader, we understand the need for liquidity and how institutions need liquidity to push price lower or to push price up. They need to get their orders, their massive orders filled. So anyway, we don't have any candlestick structure right here once the market opens at 9:30 that we can enter off of, but we are aware of supply. So we have our puts pulled up and we're looking for an opportunity to enter. We find an opportunity right here on this doji candle followed by an engulfing candle. I saw it forming in real time. So I placed a trade right here with my stop loss right here, right above here. So I'm risking 2 points to make a 20-point move down into this 45.60 range. We were right here at 45.80 when I took the trade, and we moved. my expected move was down to 45.60. We didn't quite make it there, but we still got a good trade at it. So I'm risking 2 points, and I ended up stopping out right here because I moved my stop loss down as the trade goes in my favor, and it ended up stopping me out right here because I have my stop loss right behind the base of this candle, the back of this candle, and it pulled back and it stopped me out, and I made $5,600 on 10 contracts, so right around $560 per contract. I'll show you on the option contract where it was when I purchased it. It was at 1070. Now, if you know anything about options, you know put options is for the stock to go down. They gain value by the stock going down, and call options gain value by the stock going up. So this is inverted, but this is a put option. The value was increasing as the stock went up. I paid right at 1050, 1050 per contract, which is each contract, if you multiply it by 100, you'll get the actual value. So I paid $10.50 per share times 100, which I was saying 1050, which is $1,050 per contract on 10 contracts. So my trade value, I put up 10,500. I was risking 2 points. So 2 points on a contract that's at the money. The delta was 50. 2 points is $100 per contract. So $100 times 10 would be $1,000. So I'm risking 1,000, and I was able to make 5,600. But if I had held the trade all the way, I would have made 10,000 if I was able to hold it all the way. But I go off a candlestick structure and volume on these trades, and I'll show you. I showed you I entered off of this candlestick structure right here, and I exited because it pulled back and it stopped me out, because I always move my stop loss down to protect my profits, because you never know, like you can have pullbacks in the market, so you always want to have some kind of protection on your profits. And I missed out on another 6 points down, but I'm fine with that because I captured 10 points. So again, I entered right here at 1050. It ended up stopping me out up here around 1630 or 1650, somewhere around here. I ended up making $650 per contract. And if you guys understand that, the value of this contract, if you just take the 1650 and multiply it by 100, the contract was worth $1,650 times 10. So I put in 10,500. I was able to take out 16,500, which gave me a profit of somewhere around $5,600. And as you can see, this trade worked out multiple times throughout the day. The final trade that was available actually went the whole distance. If we fast forward through the day, we went up to the supply again. It rejected. We got a double tap. You see the candlestick structure, the basing followed by the engulfing. This is a bearish candlestick structure, a bearish engulfing. We had another bearish engulfing candle to enter the trade off of. A retest of structure where we consolidated. Consolidation just means the price was moving sideways. A retest of structure that you could have taken a trade off of. And then we had just an afternoon sell-off, almost back down to our area of buyers where we consolidated yesterday. But let me show you the beauty of this. Using these same day contracts, which are more risky, But if you're trading, they're not risky because you need to get in and get out of contracts. A lot of people who have more days on the contracts, they end up staying in these contracts, and that's how they lose a lot of money because they're not planning on getting in and getting out of these contracts. Another thing when picking contracts, as you can see here, we have the high and the low of the previous day of Thursday marked out on the XPX. We also marked out the high and the low on the contracts. We subtracted the theta, which is a Greek term on the option contracts. It means time decay. So since we were at 0 days to expiration, the time decay was massive. The contracts lost $1,000 overnight just in value because of the time decay. So we marked the new area after the theta. We subtracted the theta, so we have that marked on our chart. So we were able to see if we were getting in on this contract at the low or at the high, which is very important. The other thing is the beauty I was saying before. So as this trade went back up here and touched this supply zone again at 1339. Let me find that. At 1339 right here, these contracts were worth $460 because of time decay. But the beauty of that is, since we know it's institutional sellers up there, we have bearish candlestick formations coming in. We know we had a seller up here earlier. We take this trade again. We pay $460 now per contract. And if you took this trade and you took it down to the consolidation area, you would have been able to turn $460 if you bought one contract into $1,800. This morning, if you took this same trade, you would have paid $960 at the low to turn it into $2,070. So this is a double up. This is 4x. This is 400% return, a quadruple up, 4 times your money. Some days we don't play same day contracts if the market is moving slow. But since we knew we had an aggressive seller up there this morning, just from watching the tape yesterday and the orders coming through, we knew we could play same day contracts today. But it's just something you have to learn. The more screen time you have, you can kind of feel out what contracts you need to use. But we normally play at least 3 days to expiration. Today we were able to make a profit on the same days, get in for a little bit cheaper. But hopefully this video was helpful. Hopefully I was able to explain how we turned a $5,600 profit and how I also turned a $750 profit, and how some of our members who traded one contract were able to make $545 and different amounts today trading XPX options. Thank you for your time. Don't forget to like and subscribe for future content, and check us out on Teachable. I'll try to post that link. And also check us out if you guys are on Discord. The Discord app, we're at Black Edge. Check us out. It's a trading room where a lot of knowledge is dropped, a lot of money is made, and you can actually learn how to trade from a professional. Thank you for your time. See you guys later.